Hi, I'm Josh Haskell, and this is How Subprime Mortgages Produce Tons of Positive Externalities for the Economy When Done Right, and How to Do Them Better. So what exactly is a mortgage? Let's say my name is Pete, and I want to buy a house, but I don't have the cash in hand to afford a house. Houses are massive assets, so sometimes it's hard to get all the cash. So, if I borrow it through one of these methods, I have received a mortgage. There are multiple types of mortgages, which differ in how you pay interest on your loan and how much interest you pay, but the most important ones to know are these. A fixed rate mortgage is when you pay a fixed interest rate over the entire life of the mortgage. So, if the mortgage is $1,000 and the interest rate is 10%, then you end up paying $1,100. These mortgages are predictable, and the borrower knows what they'll have to pay. To the lender, however, this method isn't as optimal as they'd like. If the inflation rate happened to rise during the life of the loan, then the borrower actually paid less than what the lender hoped. These are adjustable rate mortgages, or ARMs. The difference in this loan is that the amount of interest paid can adjust over a given time to counteract inflation. As an example, if inflation rose 2%, then our 10% adjustable rate mortgage would become 12% interest. As we can see, inflation in the US is nearly always positive, meaning that those who get ARMs nearly always pay more for their loans, which is great for lenders, but is tougher for borrowers and can cause big problems we'll see later. If a borrower who wants a mortgage has a low FICO score, generally lower than 650, then they are considered subprime. This means that they are considered at risk for not making payments toward their mortgage, or defaulting on the mortgage altogether. Therefore, subprime mortgages are seen as more risky and still considered somewhat taboo. Let's say Pete from earlier is a subprime borrower. Now, if you are a lender and want to turn a risky investment like Pete into a safer investment, what do? Right! You take tons of subprime Petes and you package them together into a bond and sell that as its own asset. So a subprime bond is organized into levels, and they're also rated for how safe they are. But basically, a subprime mortgage bond is packaging mortgages together to minimize risk. What is the benefit of making riskier subprime loans to society if they are risky? Well, subprime mortgages have multiple positive externalities. 1. They give people homes. If your credit score is low, without subprime mortgages, you probably wouldn't be able to get a home. Getting a home is also a great, safe asset to have for a family. 2. They can be turned into a safe investment. If a borrower pays their mortgage with interest, and their mortgage is formed into a bond, then they are providing good, relatively safe, yet higher than normal return when operated correctly, which we will come back to later. 3. They all around stimulate the economy. Housing, including mortgages, building, and everything that goes into housing, contributes to around 17 to 18% of the US GDP per year. In past years, between 9 and 14% of all mortgages were subprime. That's over $300 billion of value added per year by subprime. When done right, subprime housing is a massive industry that increases the GDP, and potential GDP of the United States can shift right. In the early 2000s, the mortgage market on Wall Street realized the tremendous untapped value in giving more subprime adjustable rate mortgages, as well as introducing collateralized debt obligations as an unregulated industry, and that it had a lucratively high interest rate. The issue is that the market was unregulated, and mortgage brokers were giving out more subprime adjustable rate mortgages on very expensive houses, where there was no hope of making payments. In the resulting financial collapse of 2008, where hundreds of thousands of mortgages defaulted and the market crashed, subprime was blamed and regarded as the sole cause. While it is true that subprime contributed, there is some significant good that comes out of making subprime loans. So, in order to do it better, there's one standard and regulation which I propose, which does not currently exist, which maximizes the positives of subprime mortgages for everyone and keeps the potential for financial collapse in check. I propose limiting adjustable rate mortgages, as they can be better for lenders, but in times of high inflation, borrowers under adjustable rate mortgages could all default, and not only lose their homes, but also damage the entire mortgage market. In 2006, some mortgage bonds were over 90% filled with subprime adjustable rate mortgages. I propose setting limits to the content of subprime bonds, in a way that only a fraction of the mortgages of the bond can be subprime. This makes the subprime bond safer, and if high inflation rocked the market, the bond would have less return, but it wouldn't be worthless because there's still less default. So in conclusion, mortgages are integral to the American economy. A large part of that is lending of subprime mortgages. With more regulations like mine, the positive extremities far outweigh the negative ones, and hundreds of thousands of people are able to afford houses and stimulate the economy in many unforeseen ways.